Let's talk about the employer participation guidelines. In order for an owner-employee to participate in the plan, the business must be organized as a C-status corporation or limited liability company or C-management corporation. If no C-status corporation or LLC exists, a C-tax status management corporation can be established for the purpose of providing benefits to owner and non-owner employees. Medical and dental practices and doctors employed by the professional practices are often affiliated through ownership or income source with other business entities and their employees. This affiliated service group status requires participation by all employees of affiliated group companies. The 79 plan is offered to all employees of all companies. As a result, any affiliated service group requirement do not limit the use of the plan. The 79 plan benefits are: death benefits are offered to employees through the 79 plan on a uniform basis in a non-discriminatory manner. Each eligible participant has the right to the same benefits. Benefit levels of the 79 plan are generally based on a formula such as a uniform multiple of salary or a flat amount of life insurance coverage. Now let's talk about eligibility requirements for participation in 79 plans. 79 plan participation is offered to all full-time employees over the age of 21 who have at least 3 years or more of full-time employment service with the employer. Employees covered by a collective bargaining agreement or union can be excluded. A trust may be used in the circumstance of a corporation that has fewer than 10 participating employees. The 79 plan administration companies are available to actively monitor employees' plan and employees' policies in cooperation with the insurance companies providing the insurance policies to participating employees. Let's talk about a real-life example of a doctor's use of the 79 plan, changing the doctor's name for privacy purposes. Dr. Smith operates a successful practice as a C-status corporation. He is 40 years of age and is paid a salary of $200,000 by his practice employer. He has 5 employees with an average age of 35 and average compensation of $40,000. Dr. Smith decides to have his C Corporation employer provide a Section 79 plan for the employees of his C tax status corporation practice that provides a death benefit of 10 times each employee's compensation. The corporation employer's annual tax deductible cost for the employees based on their selected plan coverage of $50,000 is $6,000. The employee elect to receive $50,000 of group term insurance to eliminate any personal taxation on the cost of the group term insurance benefit they receive. Dr. Smith elects to receive a permanent benefit that has an annual tax-deductible contribution of $100,000 by his practice employer for 5 years. Dr. Smith is taxed on the annual cost of the value of the permanent benefit provided by his permanent benefit life insurance policy. The permanent benefit is defined by the IRS as the permanent direct cost of the permanent or whole life death benefit provided by the policy. In this example, the direct cost of the benefit is $60,000 per year. Dr. Smith would also have an annual Table 1 cost for benefits above $50,000 group term cost, which is approximately $3,200. Dr. Smith would have personal tax costs of $27,280 each year, assuming a 40% combined and state federal tax rate for 5 years. The total cost to Dr. Smith for the $500,000 of pre-tax earnings that would be allocated to the annual cost of his permanent benefit is $152,000. After the 5-year funding period for his permanent benefit plan by his C-status corporation employer, Dr. Smith has a personally owned whole life insurance policy that is projected to require no more premium payments to maintain the death benefit of the policy. The whole life insurance policy protects his family from the catastrophic loss of earnings that would result from his pre-retirement death and provides tax-free spendable retirement distribution if he lives to normal life expectancy. In this example, at age 65, Dr. Smith can receive annual spendable retirement distributions of more than $65,000 each year for 20 years in the form of annual loans from his policy. Dr. Smith would receive more than $1,300,000 of spendable retirement distributions to finance his lifestyle cost if he lives to age 85. Upon his death, the cumulative loan of his life insurance policy would be repaid with a portion of the income tax-free death benefit as provided under Internal Revenue Code Section 101A. The 79 plan has enabled Dr. Smith to spend the tax-free death benefit of his own life insurance policy while he is alive. The spendable distributions that Dr. Smith receives from his 79 plan are the equivalent of the spendable distributions he would receive from a qualified retirement plan or IRA accumulation of $2,200,000 at age 65, assuming that 40% of the retirement plan distributions he receives from the qualified plan or IRA are lost to income and other taxes, that the $2,200,000 qualified retirement plan or IRA accumulation at age 65 experiences no investment losses for 20 years, and that the declining retirement plan or IRA accumulation continues to grow at a tax-deferred annual rate return of 5% during the 20-year period of annual distributions. There is no question that the 79 plan maximizes the efficiency, control, and safety of the conversion of Dr. Smith's earnings into current income protection and future spendable distributions. The 79 plan maximizes the conversion of his earnings into a leveraged, tax-free mortality gain of $2 million if he does not live to normal retirement age, and maximizes the conversion of his earnings into $1,300,000 of spendable distribution if he lives to age 85. I think that you can see why I am so enthusiastic about the 79 plan and its capacity to help doctors and other owners achieve their capital accumulation planning objectives. I am certain that the 79 plan can provide benefits to doctors and other productive business owners. The first step is to contact me at my email address